Hey, what's going on, everybody? This is Ron Sneller coming at you with another success story of cash value life insurance crushing the traditional 401k for retirement income. This is a real story of a client that I worked with last week. We already got his policy issued. It's on the books and it is in force. So what's the story this time? Well, we've got a 56-year-old gentleman who plans to work about another 10 years, and he wants reliable, safe, after-tax spendable income that he can depend on a consistent, reliable basis. So this is what we did for the gentleman. So during the accumulation phase of this product, again, he's got 10 years left to work, so we're going to fund the contract for 10 years. $10,000 annual contribution to this life insurance contract. So the projections based on today's interest rates and dividends, and of course, life insurance dividends aren't guaranteed, but as we've talked about before on this podcast or on this channel, companies, they illustrate and project their dividends very, very conservatively to kind of under promise and over deliver. So projected $10,000 per year for 10 years with dividends, $100,000 total contribution, and after 10 years, his cash value will be $104,921. So almost $105,000. That's a lousy rate of return, isn't it? But again, true wealth isn't about chasing rates of return. True wealth is about the distribution mechanism, how the distribution works, and more importantly, how that distribution is treated by the tax code. So there is more to this story. Let's check it out. So during his distribution years, he's going to be able to receive almost a 7% distribution rate from his insurance contract. We ran it out income to age 90. So he's going to be able to receive from this contract $6,957 per year, consistently, reliably, and it's completely income tax exempt. No federal income tax, no state income tax, no Social Security income tax, no local tax. It does not count on his Medicare premium offset calculation either. So he's got $6,957 per year of actual spendable income that won't affect any of his other benefits. So if we wanted to mimic that distribution using the traditional strategy of a pre-tax 401k, what would need to happen over those 10 years with the new money going in? So we're going to start with the end goal in mind, which our end goal is to receive $6,957 per year of after-tax spendable income. His assumed tax bracket, 12% federal, 4.25% state of Michigan. We're just going to round that down to 4. So we're going to assume 16%. Now, in 10 years, guess what? Our current tax law will have expired. So it's very possible that when he retires, his actual tax rate will be 20%, 25%, 30%, who knows, right? But I'm just trying to be conservative and illustrate what the tax rates are today. So with the 16% tax bracket, he would actually need to withdraw $8,282, pay 16% tax to net $6,957 per year. Now, using the safe withdrawal rate of 3%, again, I've talked about it before. I'm not going to go super in depth. Some people know about the 4% safe withdrawal rate that they use for the Monte Carlo simulations. But again, that number was done, the research done in the 1990s, but a lot has happened since then. Stock market volatility, low interest rates, so on and so forth. So in 2013, Morningstar partnered with the American College of Financial Services. They got a group of economists and researchers together to look at the new safe withdrawal rate, and it's actually 2.8% now. I linked the article to the bottom of your screen, so if you do want to come back and just nab that, or you could Google search it pretty easy. But again, we're using the assumption of a safe withdrawal rate of 3%. So the account balance that this gentleman would need after 10 years, he would have to put $10,000 per year into his 401k every year for 10 years. He would have to grow his account balance to $276,000. It would take $276,000 of capital to distribute 3% a year to get that $8,200 and then pay the taxes in net the $6,900 that he's getting from the life insurance contract. So what kind of performance would he need the stock market and his investments to do over those 10 years to build that hypothetical account of $276,000? Again, it's $10,000 annual contribution for 10 contribution years to get an ending balance of $276,000. He would need the stock market to perform 18% net every year for over 10 years in order to equal what he's going to get from his cash value life insurance policy. My question to you is, do you think that it's probable that the stock market's going to return an average of 18% a year, every year for the next 10 years? If so, go ahead and invest in your 401k. If not, you might want to look at other alternatives, because a lot of financially savvy and wealth-minded people are starting to understand that wealth is not about chasing rates of return like the financial planning industry and like Wall Street has taught you. They want to get a bunch of your money under management so they can make their fees. But to you, you care about after-tax spendable money from the distribution. And again, when this gentleman takes his distribution, his $6,900, there'll be no federal income tax, no state income tax, no local income tax. It will not count in the provisional income calculation to make his Social Security benefits taxable, and there will be no Medicare premium offset. And in fact, if somebody structured their entire financial lives this way and took all of their income from a cash value life insurance policy, they could be pulling in distributions of $100,000 per year, and they would still qualify for welfare. And I mean it. Food stamps, Obama phone, Obamacare, all the government cheese, because life insurance distributions under the tax code, it's not classified as income. So they could be pulling $100,000 of distributions a year, but on paper, they're dirt broke and they're poor, and they would qualify for welfare. So, my friends, again, understanding how wealth works is about distribution mechanisms and how it's treated by the tax code. It's not just about building up some big pile of money and chasing rates of return like we've all been conditioned to. So once again, that is how cash value life insurance crushes the traditional pre-tax 401k. Well, that's my rant. Thanks for listening.